All right, let's get right into it. There's a major conflict happening thousands of miles away, but its shockwaves, they're already hitting us right here at home. We're talking about our markets, our currency, and yeah, even our wallets. We're going to break down exactly how this whole thing works.
It's a totally fair question, right? How does some big geopolitical crisis suddenly become your personal economic problem? Well, it happens through this incredible chain reaction, one that connects global oil prices directly to the cost of pretty much everything you buy.
And that's really the heart of it. This isn't just some headline you can scroll past anymore. The economic fallout is here, and it is real. So let's unpack what's going on, starting with the big global picture.
First things first, we need to understand why this conflict has the entire global economy on the edge of its seat. It all boils down to one single commodity that powers, well, everything: oil.
So this conflict messes with the global economy in three main ways. First, pretty obviously, it can hit actual energy production. Second, it threatens these supercritical shipping routes. Think of the Strait of Hormuz, which is like a giant highway for the world's energy trade. And maybe most important of all, it just completely shatters market confidence.
Now this is where it gets really interesting. There's this thing called the fear premium. See, the price of oil doesn't just react when supply is actually cut off. It can skyrocket based on the fear alone that a shortage might happen in the future. Traders, companies, everyone starts betting against that risk, and that fear itself is what sends prices through the roof.
And you can see the real-world impact right here in the numbers. The OECD has already had to adjust its global forecast. So instead of that nice, clean economic recovery everyone was hoping for, the world is now bracing for slower growth and higher inflation. We're staring down another major energy shock.
And you know, energy shocks are just so damaging because their impact spreads like wildfire. It's not contained to one little area. Higher energy costs just bake themselves into everything: the cost to ship goods, the cost to make things, and yes, even the price of the food on your table.
Okay, so that's the global scene. Now let's zoom in and bring this story home to India. Why is the country feeling this shock so much more than many others?
Well, the answer is actually pretty simple and pretty stark. India imports a massive amount of its oil, so when global prices jump, it's not really a political debate for us, it's just simple arithmetic. A bigger oil bill means instant, unavoidable pressure on the economy.
And here's exactly how that pressure snakes its way through the entire system. Oil prices go up. That means India's import bill gets bigger. To pay that bill, we need more US dollars. That extra demand for dollars makes our rupee weaker. And a weaker rupee makes everything else we import more expensive. That's what we call imported inflation.
And the effect has been, well, pretty dramatic. Just recently, the rupee tumbled to a record low against the dollar. Now, this isn't just some number for Wall Street. It's a huge flashing sign showing the intense pressure on the Indian economy.
And at the very same time, look at this. We're seeing a ton of money leave the country. Foreign investors have pulled a whopping $19 billion out of Indian stocks. Now, this isn't them saying India's a bad bet forever. It's just a sign that when things get risky globally, investors tend to retreat from emerging markets.
The pressure doesn't stop with stocks and currencies either. It's hitting the bond market too. You can think of government bond yields as the base interest rate for the whole economy. When those go up, it gets more expensive for everyone to borrow money, from the government down to big companies and, eventually, you and me.
So, with all this pressure building up, the Reserve Bank of India, our central bank, had to do something. But the big question everyone's asking is, was their move a real long-term fix, or was it just a temporary band-aid?
You know, the key to understanding what the RBI did is to ask this simple question. A central bank doesn't just make these kinds of unusual moves for fun. They do it when they see a serious problem in the system that they need to fix, and fast.
So what did they do? Well, to put it simply, they basically put a limit on how much banks can gamble on the currency. The whole goal was to cool things down, to take some of that wild, speculative pressure off the rupee that was making its fall even worse.
But, and this is a really important but, what the RBI did was like fixing a leaky pipe. It's absolutely essential to stop the immediate panic, to stop the flooding. But it doesn't change the fact that there's a hurricane raging outside. The root problem, high oil prices and global risk, is still there. And this puts the RBI in what you'd call a classic policy trap. It's a real damned if you do, damned if you don't situation. If they raise interest rates now to fight inflation and support the rupee, they could seriously hurt our economic growth. But if they wait too long, they risk inflation spinning out of control and losing all their credibility. There are just no easy answers here.
All of this uncertainty leads us to the final crucial question. So what happens next? Right now, the market is completely torn between two very, very different versions of the future. On one hand, you have the optimistic story. This narrative says this is all just a temporary, even if it's a painful, shock. In this future, the conflict eases up, oil prices come back down to earth, and the rupee bounces back. But then there's the other, more pessimistic story. This one says we've entered a whole new reality of permanently higher oil prices and constant risk, which would mean a long, stressful period for the Indian economy. And honestly, nobody knows for sure which path we're on.
So instead of trying to predict the future, let's do something much more useful. Let's build ourselves a dashboard, a simple set of signals you can watch to see how this story is unfolding for yourself. You only need to keep an eye on 5 things. Number 1, the price of Brent crude oil. That's the source of all this pressure. 2, the rupee versus the dollar, obviously. 3, Indian bond yields. That tells you about the cost of borrowing. 4, where that foreign investor money is going. And finally, number 5, listen very carefully to the RBI's next announcement. Their words are going to be just as important as their actions.
And that really leaves us with this final, powerful idea. A distant war is no longer just some abstract foreign policy issue. It's become a direct economic pipeline, flowing through oil prices, into our currency, and straight into our markets. If you want to understand the Indian economy right now, the biggest takeaway is this. Geopolitics has officially entered the balance sheet.